In our today's video we are going to learn what is dollar cost averaging, a strategy for long-term investing. So let's go. Dollar cost averaging, DCA, is a long-term investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the current price of the investment. It aims to mitigate the impact of market volatility and reduce the risk of making poor investment timing decisions. Here's how dollar cost averaging works and its key benefits. 1. How dollar cost averaging works. Fixed investments. With DCA, you commit to investing a fixed amount of money at regular intervals, such as monthly or quarterly. For example, you might invest $500 every month into a specific investment. Buy more in dips. When the investment price is high, your fixed investment amount will buy fewer shares. Conversely, when the price is low, your fixed investment amount will buy more shares. Accumulating shares over time. By consistently investing the same amount, you accumulate shares over time, regardless of the investment's price fluctuations. 2. Benefits of dollar cost averaging. Mitigates timing risk. DCA helps mitigate the risk of making poor investment timing decisions by spreading out purchases over an extended period. It reduces the need to accurately predict market highs and lows. Potential for lower average purchase price. Since you buy more shares when prices are lower and fewer shares when prices are higher, DCA can lead to a lower average purchase price compared to investing a lump sum at a single point in time. Emotional discipline. DCA encourages disciplined investing and reduces the tendency to make investment decisions based on short-term market movements or emotional reactions. Automatic investing. DCA can be set up as an automated investment plan, allowing for consistent and regular contributions without the need for constant monitoring or active decision-making. 3. Considerations for dollar cost averaging. Suitable for long-term investing. DCA is generally more suitable for long-term investment horizons, where you have time to ride out short-term market fluctuations and benefit from long-term growth potential. Market conditions. DCA works best in markets that have volatility or where prices can fluctuate significantly over time. In stable or steadily rising markets, lump sum investing may be more appropriate. Transaction costs. Consider transaction costs associated with each investment, such as brokerage fees. These costs can impact the effectiveness of DCA, especially for smaller investment amounts. Asset allocation. DCA is a strategy for investing in a specific investment or asset class. It's important to consider overall asset allocation and diversification within your investment portfolio. 4. Implementing dollar cost averaging. Set investment schedule. Determine the regular intervals at which you will invest, such as monthly, quarterly, or annually. Determine investment amount. Decide on a fixed amount you will invest at each interval. Automate contributions. Consider setting up automatic contributions through a brokerage or investment account to ensure consistency and eliminate the need for manual transactions. Remember, while dollar cost averaging can help reduce the impact of market volatility and improve long-term investment outcomes, it does not guarantee profits or protect against losses. It's important to align your investment strategy with your financial goals, risk tolerance, and time horizon. Regularly reviewing and adjusting your investment approach in consultation with a financial advisor can help ensure that your investment strategy remains appropriate for your changing needs and market conditions.